Ladies and gentlemen, something big is happening right now, and it is unfolding quietly beneath the noise of daily headlines. While markets argue over short-term data points and political soundbites, a far more powerful signal is flashing across the global financial system. Gold has surged to new historic highs, trading firmly above the $2,400 level per troy ounce, touching areas once considered unthinkable. At the same time, the US dollar, long seen as the backbone of global finance, is weakening, sliding toward multi-year lows. This is not coincidence, this is a message. Gold moving to record levels is never just about gold, it is about confidence. It is about trust in currencies, in governments, in fiscal discipline, and in the stability of the world order. When gold breaks higher while the dollar breaks lower, markets are telling a story of transition, a story of uncertainty, a story of protection. Over the past months, gold has climbed relentlessly, pushing past previous resistance zones near $2,300, then accelerating toward the $2,400 to $2,500 range. These moves did not happen overnight. They were built layer by layer, as investors across continents quietly adjusted their expectations. Central banks increased gold holdings. Long-term funds rebalanced portfolios. Private wealth sought safety. This was not panic buying. This was strategic positioning. At the same time, the US dollar index, which measures the dollar against major global currencies, drifted lower, slipping from levels above 105 toward the low 90s range. That decline may seem modest on the surface, but in currency markets, it represents a meaningful shift. A weaker dollar changes everything. It makes commodities more attractive. It inflates the value of hard assets. And most importantly, it reflects growing concern about future purchasing power. Bond markets are reinforcing this signal. Long-term government bond yields have remained elevated, hovering around 4% or higher in many cases, even as growth expectations soften. This combination is unusual. High yields typically support a strong currency, yet the dollar continues to weaken. This tells us investors are demanding higher compensation for holding debt, not because opportunity is booming, but because risk is rising. Inflation expectations remain sticky. While headline numbers may fluctuate, the underlying pressure on prices has not disappeared. Energy costs remain volatile. Supply chains remain fragile. Fiscal spending continues at historic levels. Governments across the world are running deficits that would have been unthinkable a generation ago. Markets see this. They price this in. Gold, as it has for thousands of years, responds first. Geopolitical risk is the silent accelerant. From trade tensions to regional conflicts, from fractured alliances to economic nationalism, the global landscape is becoming less predictable. When uncertainty rises, capital looks for neutrality. Gold does not belong to any government. It carries no counterparty risk. It cannot be printed. In moments like these, that simplicity becomes powerful. Psychology matters here. Investors are not just chasing returns. They are seeking resilience. They are asking a deeper question. What holds value if systems are strained? When currencies are questioned, when debt levels expand, when political outcomes feel binary, gold becomes more than a metal. It becomes a statement of caution. This surge in gold prices is not driven by hype. It is driven by alignment, weakening currency signals, persistent inflation pressure, expanding fiscal uncertainty, elevated geopolitical risk. All of these forces are moving in the same direction. Markets rarely ignore such alignment for long. What makes this moment especially important is timing. These moves are happening before a full economic downturn, not after. Historically, gold tends to surge when confidence erodes ahead of visible stress. By the time crises become obvious, the biggest moves are already behind us. That is why this rally matters now, not later. We are witnessing a recalibration of value. Not a collapse, not a panic, but a reassessment. A recognition that the global financial landscape is shifting, slowly but decisively. Gold at record highs alongside a weakening dollar is not a warning of immediate disaster. It is a signal of long-term adjustment, and markets are listening. This adjustment is visible not only in prices, but in behavior. Large institutional investors are no longer treating gold as a tactical hedge. They are treating it as a strategic core holding. When gold held above $2,300 and did not meaningfully pull back, it signaled strength. When it pushed through $2,400 despite high real yields, it confirmed conviction. Markets rarely send the same message twice. The weakening dollar plays a central role in this story. For decades, global trade, debt, and reserves have revolved around the U.S. currency. That dominance is not disappearing, but it is being questioned. Persistent fiscal deficits, rising interest expenses, and political gridlock are slowly eroding the perception of stability. As government debt expands beyond $30 trillion and refinancing costs climb, confidence becomes more fragile. A currency does not collapse suddenly. It weakens gradually through trust. As the dollar softens, countries and investors with dollar exposure feel the pressure. Purchasing power matters. When the dollar index drifts lower, gold naturally benefits, but the deeper issue is what that decline represents. It reflects concern that future dollars may buy less than expected. In that environment, tangible assets regain relevance. Central bank behavior offers another powerful clue. In recent periods, central banks have been consistent buyers of gold, adding hundreds of tons to their reserves. This is not speculative behavior, it is structural. Central banks think in decades, not quarters. Their actions suggest a desire to diversify away from heavy reliance on any single currency system. Gold provides neutrality, it provides balance, and it provides credibility in times of stress. Interest rate policy adds another layer. Despite aggressive tightening cycles, inflation has proven resilient. Even as policy rates remain high, real purchasing power has not fully recovered. Markets understand that keeping rates elevated indefinitely comes with consequences. Economic growth slows. Debt servicing becomes harder. Political pressure builds. Eventually, something has to give. Gold tends to move early in anticipation of that moment. Bond yields tell the same story from a different angle. When 10-year yields hover near 4% or higher, yet gold continues to rally, it breaks a traditional relationship. Normally, higher yields compete with gold, but when yields rise because risk premiums rise, gold can climb alongside them. That is exactly what we are seeing. The market is not chasing yield, it is pricing uncertainty. Geopolitical fragmentation reinforces this dynamic. Trade routes are being reassessed. Supply chains are being reshaped. Strategic resources are becoming tools of policy. In such a world, efficiency gives way to resilience, and resilience has a price. Gold fits naturally into that framework. For individual investors watching from the sidelines, this can feel confusing. Headlines talk about growth, jobs, and technology, yet gold speaks a different language. It speaks the language of protection, of balance, of history. Every major period of economic transition has left its mark on gold prices. The metal does not predict events. It reflects probabilities. The current probability distribution favors volatility, not necessarily collapse, but instability. Fiscal negotiations, monetary recalibration, and geopolitical tension all intersect at once. When too many variables move together, markets seek anchors. Gold has become one of those anchors again. What makes this moment particularly compelling is that fear has not peaked. Volatility indices remain relatively contained. Equity markets still show optimism. That tells us this gold move is not driven by panic. It is driven by foresight, by preparation rather than reaction. When gold trades near $2,500 without triggering widespread euphoria, it suggests the market sees higher risk ahead, but remains composed. That is often the most powerful phase of any trend. Quiet conviction tends to last longer than loud fear. The weak dollar, the firm gold price, the elevated yields, and the cautious tone across global policy all point to the same conclusion. The financial system is adjusting to a new balance. One where certainty is lower, buffers matter more, and historical stores of value regain importance. This is not about abandoning currencies or betting against growth. It is about acknowledging that the world is more complex than it was a decade ago, and complexity changes how capital behaves. And this brings us to the deeper meaning of what gold at record highs truly represents. It is not a rejection of progress. It is not a bet against innovation or growth. It is a mirror held up to the global system, reflecting stress points that are still forming beneath the surface. When gold holds its ground above $2,400, it suggests markets are no longer asking whether change is coming, but how profound that change might be. History shows that periods of monetary transition are rarely comfortable. They are marked by experimentation, policy recalibration, and shifting power dynamics. Today, we see governments balancing growth against inflation, stability against debt, and domestic priorities against global cooperation. Each compromise leaves a footprint in financial markets. Gold absorbs those footprints quietly. The dollar's role remains dominant, but dominance does not mean invulnerability. As more trade agreements explore alternative settlement mechanisms and reserve diversification continues, the psychological monopoly of any single currency weakens. Even small shifts, when accumulated over time, can alter global flows. Gold benefits not because the dollar disappears, but because diversification becomes rational. What makes gold unique is its lack of promise. It offers no yield, no growth story, no policy support. And yet, in moments of doubt, that absence becomes its strength. There is no central bank meeting that can dilute it, no fiscal package that can inflate it. Its value rests entirely on collective trust built over centuries. For the global audience watching these developments, the message is subtle but clear. This is a time for awareness, not fear. Markets are signaling that assumptions built in an era of cheap money and predictable globalization are being reconsidered. That does not mean decline, it means adaptation.